Hello and welcome to this webinar on pension contributions. I'm Lisa Webster, Senior Technical Consultant at AJ Bell. So today what we're going to look at on terms of contributions then is, first of all, a little bit look at the basics of who can contribute to a UK pension. We're then going to have a look at how the tax relief work, the different systems that we have in pension schemes in the UK, and how tax relief works, including, when we have to do self-assessments, claim additional rate relief, etc., etc. Look at the different methods of that. I'll then go on and talk a little bit about refunds, the circumstances when refunds are allowed in pension schemes. There aren't that many, but I'll have a look at when it is possible and what you need to do to process those, what information the scheme administrators will need to process those. And then I'll finish off talking just a little bit about annual allowances and how they interact with the ability to claim tax relief on pension contributions. I'm not going to go into an awful lot of detail in annual allowances in this session, just because of time, and it would be a very long session if I did. We will be later on in our programme, our Off the Road series, we will be doing another webinar where I'll look at annual allowances in a lot more detail. So first of all then, we're going to look at the who can put money into a UK registered pension scheme. Well, most obviously, we have the member, person individually, a pension scheme member, they can put money into their own pension scheme. Next most common one we have is the employer. Obviously, employer contributions, we'll look at the details of that as well. But also, it's important to remember that we can also have what we call third-party contributions. Basically, HMRC rules allow anybody to pay into a UK registered pension scheme. Obviously, providers have to be careful where the money's coming from in terms of anti-money laundering considerations, but there's no other limits from HMRC in terms of who can pay in. So the answer is pretty much anybody can pay into a UK registered pension scheme, but in practice, the reason why anybody wants to pay in really is because of the tax advantages and the tax relief, and there are restrictions on who can get tax relief. So that's really what we're going to be looking at. So first of all, I'm going to look at member contributions. So for an individual to be able to put money into their pension scheme, to a UK registered pension scheme, and be able to get tax relief on those contributions, there's three sort of main criteria they have to meet. They have to be a relevant UK individual, they have to be under the age of 75, and then there is this limit in terms of how much they can put on in terms of their earnings. So looking first of all about who is a relevant UK individual. First of all, you only have to meet one of these four sub-criteria that I've got here. First one is that you have to have earnings in the UK. So for most people, that's just going to be employment income, salary, wages. Does include things like statutory sick pay, statutory maternity pay if they're paid by the employer, or for those that are self-employed. So employment income subject to income tax in the UK. Any income that's derived from a trade, profession or vocation. There's also a few quirky ones, things like income arising from patent rights counts as UK earnings, general earnings from overseas Crown employment. Importantly, it's anything that's not included, will be anything that's not taxable in the UK. Also, it is earnings, so it doesn't include things like dividends, interest on savings. Importantly, it doesn't include pension payments. So somebody who's in receipt of a pension, maybe paying income tax on that, but that doesn't count as earnings for the purposes of having UK earnings to then be able to pay back into a pension scheme. So if you have any UK earnings, you will automatically be a relevant UK individual. You can also be, if you're a UK resident, even if you don't have any earnings, then you're still classed as a relevant UK individual. We also have Crown employees. So obvious examples would be somebody, armed forces or the like, somebody working overseas, diplomats working in an embassy, whatever it may be, plus their spouse or civil partner. They will also count as a relevant UK individual. And then the last one is an interesting one. So somebody who was resident in the UK when they joined a pension scheme will continue to be for the 5 years after they've left. So That just means you may have clients that are UK residents, maybe clients of yours for some time, they've set up a pension scheme, and when they've retired abroad, for example, or they've emigrated at some point. This just means that even after they've left the UK, for the following 5 years, they are still classed as relevant UK individuals. So they are still eligible to make contributions, tax relievable contributions into a UK registered pension scheme, even after they've left the UK, say for the following 5 years. It may, of course, be that they don't have any relevant UK earnings anymore, in which case they would be restricted to the £3,600 basic amount, which they could pay in. Of course, when I talk about sort of the maximums there, it says higher of relevant UK earnings than 3,600. That 3,600 is the gross payment. So somebody who didn't have any earnings making a payment into a personal pension, they'd actually paying the £2,880 would be the net amount. And then by relief at source, they would receive the additional £720 tax relief to bring it up to the £3,600. And of course, this allows non-earners to pay into pension still, as long as they're relevant UK individuals. So in most cases, you're talking about a UK resident. It could be a non-working spouse. It's also why we can have junior accounts. So we have junior SIPs. So as long as the child is a UK resident, they may not need to have any earnings. Parents, the family members can pay in for them on their behalf up to this 3,600. And of course, we just have the age limit on here of under 75 as well for making relievable contributions. One important note on member contributions is that any third party that makes a contribution, so for example, a parent making a contribution for a child, or a spouse making a contribution for the spouse or partner, then it is treated as if the member paid that contribution themselves. So the limit in terms of the higher of relevant UK earnings and 3,600 will apply to the member whose pension it is, even if someone else is paying it in their behalf. And even if the person paying it is a higher rate taxpayer, if the person who's receiving the contribution, whose pension is receiving the contribution, is only a basic rate taxpayer, then they'd only get basic rate relief on it in the scheme. Another question we get asked about quite a lot is sort of date of contributions, and this is particularly relevant around tax year end. It's also relevant at other times of year for when it comes to employee contributions for company year ends. So this is about the date that the contribution is actually counted as being received by the pension scheme. So it depends a little bit on the method of your contribution, of what the deemed date will be, according to HMRC. So if you're old school and you're writing checks still and sending checks in, then it is the date that it's received by the scheme administrator that's counted as the date of the contribution. So it doesn't matter, if you've sent in, you can evidence that it's been posted on a certain date. The relevant factor is going to be when it's received. So if there's any delays in the post, then it's just tough, really, because it's when it's received. So with checks, it may be why you may consider, if it's time sensitive, you may be using either an alternative method or sending things special delivery. For credit and debit card payments, it's the date that details of those cards that's making the payments received by the scheme administrator. So that's normally pretty much same day. For direct debits for regular contributions, these will be the date of the direct debit that is authorised to draw the sum from the bank account, so that when the pension provider can take that money out of the account under the direct debit agreement, that will be the date of the contribution. Faster payments we're used to being pretty much instant, and in most circumstances they are, but obviously that's not guaranteed, so it isn't always the case, and it can occasionally cause issues, which I shall look at a few of these now. And I say the issues normally are around tax year end. I say it can be around company year ends for companies, for employer contributions as well. But sort of give you some examples. If a cheque is received and then it's not honoured by the bank, so for example, you might have one that comes in, I don't know, 2nd of April, send it in, but it's not honoured by the bank for whatever reason, and then it has to get represented and it's in the next tax year. and it clears on second attempt, even though it was received initially in one tax year, it can't be received. It can't be sort of backdated, even if it's received in the earlier year. I remember having one of these a couple of years ago where the bank didn't honour it because they said the signature didn't match. They weren't happy with it, sent it back. They ended up actually accepting that cheque eventually without it being re-signed. Carried out some other checks, but they still on that one, we weren't allowed to backdate it. So, you know, just want us to be aware of sort of cautionary tales. Direct debits, if the direct debit was due, say before 6th of April, but it failed because of lack of funds, and then we reprocess it, the scheme administrator reprocesses it after it, even though we tried to do it in one tax year, it wouldn't count until the next tax year if we couldn't physically take it at that point in time. The only exception really with the direct debits is if you have one that's due, for example, on the 4th or 5th of April, but that happens to be on a weekend, and so the first working day in the new, that we can take it after the date given on the direct debit is on the 6th of April, then we can class that as the earlier tax year if it falls on a non-working day. Obviously, you can avoid these kind of issues by not having direct debits on the 5th of the month, 4th or 5th of the month, around then. And then the faster payments one that I touched on. And again, we quite often see this because people expect them to be same day, but most of the schemes in the small print somewhere don't actually guarantee that you will have that it is going to be the same day. So if there's somebody, if the member initiates a payment expecting it to go through same day, so they do it, say, for example, on the 5th of April, but actually it doesn't come through till the 6th, the fact that they did it a faster payment on the 5th of April doesn't mean that we should class it as the 5th of April in terms of HMRC rules. We're not allowed to. We do have to still class that as the 6th of April when it's actually received, even though, you know, you would think it might have gone through the day before. So you just have to be a little bit careful with some of these around deadlines. Moving on now to tax relief and the different methods of getting tax relief on member contributions. So the main methods that we have in UK registered pension schemes are relief at source and net pay. So with relief at source, the contribution goes into the pension scheme net of basic rate tax. So if you want £1,000 in the pension scheme, the member puts in £800 and the administrator claims the basic rate tax, the £200, and you end up with £1,000 in the scheme. When it comes to net pay schemes, the first thing to remember is that only occupational schemes can offer net pay. Personal pensions are always going to be relief at source, whereas occupational schemes can be either net pay or relief at source. Under a net pay scheme, the employer deducts the contribution from salary before the tax is paid and pays it across to the pension scheme, so you never pay the tax on it in the first place. So two slightly different methods. I'm going to have a look now at how this actually works in practice with an example. Now, the figures on here are for England, Wales and Northern Ireland. For those of you north of the border, or with clients north of the border, the principle is the same, but your tax allowances and bands are obviously different than the rest of the UK. So in this example then, I've got somebody whose annual earnings are £78,000 a year, and they're wanting to make member contributions of 5%, which works out on a monthly basis as £325 gross contribution. So first of all, if we look at the relief at source scheme, they get their basic pay, which is their gross pay, which is £6,500 a month. There's no gross pension contribution under a relief at source scheme. If we then look at the tax position, so they get their personal allowance, which for the 2020-21 tax year is £12,500 a year, which works out as £1,042 a month. So that gets deducted. So the amount that they actually pay tax on, the taxable pay, is the £5,458. They then have their basic rate band, which works out as £3,125 a month, which you pay basic rate tax on at 20%. And then the rest of their earnings above that will be taxed at a higher rate at 40%. They're obviously not breaking into additional rate band on the level of earnings that we're looking at here. We also have to deduct national insurance contributions. Now, national insurance contributions will be based on the full £6,500 on that, but then they have the band earnings. So the band earnings they pay 12% on, and then 2% on earnings above that. So we do the calculations on that and work that one out too. So from the taxable pay, you deduct obviously your income tax, you deduct your national insurance. We then have to add back in the personal allowance. So you still get that, you just don't pay tax on that bit. And so we end up with the net pay figure there, which is the £4,490. So that's the figure that's actually paid into the member's bank account each month. So this individual then wants to make their personal pension contribution. They want to get £325 into their pension scheme. It's a relief at source scheme, so they pay it net of basic rate tax. So they actually only need to pay in the £260 from their bank account, which has just received the £4,490. So they pay that into their pension scheme. The scheme will then claim the basic rate relief on that, £65, which will bring it up to £325 within the pension scheme. But this individual is a higher rate taxpayer, so they'll also need to personally claim the higher rate relief. So that'll be an extra 20%, an extra £65, which eventually they will get that, effectively they will get that back, which I'll look at in a moment, how the method for doing that. But they get that back, so effectively means they end up with £4,295 at the end of the month and £325 in the pension scheme. If we turn now to look at the net pay scheme, I do exactly the same again. So same starting point in terms of earnings, basic pay for the month of £6,500. This time the pension contribution goes in gross. So the employer deducts the pension contribution from the salary before tax is taken. As it's gross, that goes directly to the pension scheme. The pension scheme doesn't claim any tax relief on it. When we're looking at the tax position, then we still deduct the personal allowance, which is the same as under relief at source, but we end up with the figure there for taxable pay, which obviously is a bit lower because we've had the gross pension contribution come out already. So in this scenario, the taxable pay is £5,133. The basic rate tax will be exactly the same because you have the same band of earnings, but what we have here is less income that falls into the higher rate tax band. So the amount higher rate tax that is paid is actually lower under the net pay scheme. National insurance contributions are on the 6,500, exactly the same as under relief at source, so they're exactly the same. So from that taxable pay figure, we deduct the income tax, we deduct the national insurance contributions, we add back in the personal allowance, and the net pay that you get into the bank account at the end of the month there is the £4,295. So we can see that we end up in the same position. The relief at source, we've had the £260 contribution, scheme claims £65, you end up with £325 in the bank account, sorry, in the pension scheme, £4,295 in the bank account. Under net pay, that £325 contribution goes in gross, and you still end up with £4,295 in your bank account. So two different methods, but you end up in the same position. Obviously, there are exceptions for low earners who don't have personal allowances, which I'm not going to go into all the details of that today. I'm guessing most of your clients probably don't fall into that position. They're not the people who normally have financial advisors, but that's how the net pay issue arises. Just a thought going back to deemed date of contributions. Under net pay, when the contribution is deducted from salary by the employer, it's actually the date it's deducted from that salary by the employer that is the deemed date of contribution, even if it isn't actually paid to the pension scheme until later, because of the way it comes out, it's a little bit earlier. That's the deemed date of contribution. Under a relief at source, obviously, if the member's making it personally, as in this example, it'll be, as I talked about earlier, but some workplace pensions, even on a relief at source system, the employer can facilitate the payment. It will still come out after all tax and everything else, as I've described it here, but they just literally facilitate that payment and take it out after tax and pay it across. In those circumstances, it's the date the employer pays it across, not the date it's deducted under relief at source, so it's slightly different, so just want to be aware of on that. Moving on now to salary sacrifice. I thought it was worth talking about this whilst we're looking at different methods, though technically this is an employer contribution, not a member contribution. What we're doing here is, rather than deducting contributions, say as personal contributions, the individual is giving up a portion of their salary in exchange for an increased pension contribution from their employer. So if we use the same starting point in the example of somebody who has £78,000 a year salary, But here, this is actually before the sacrifice. So if they're wanting to make the same £325 a month gross contribution, but they're using salary sacrifice, their actual salary, their earnings after the sacrifice will only be £74,100 a year, which works out as the basic pay for the month of £6,175. So there's no contribution going out on this. You still deduct the personal allowance to reach their taxable amount of £5,133. We then work out the tax on that. So we have the basic rate tax band, as in the other examples. The higher rate tax here, because the pay is less, obviously it's less than the higher rate tax, that actually works out as the same figure as we had on the previous page under the net pay scheme. That's the same. But the difference you get here is when it comes to the national insurance contribution, because the national insurance contributions are calculated on a pay of £6,175 a month. Not the higher figure of 6,500 that we had on the previous slide. So that's where the difference comes in. That's where the savings come in for salary sacrifice. So you end up on this one with a net pay, you take home pay here of £4,302 versus on the previous slide it was £4,295. So it's a £7 a month savings, which is the national insurance savings for the employee. The employer will also have national insurance savings, which they may choose to pass on to the employee in the form of a higher pension contribution, or they may not. They may keep it themselves, and therefore they benefit a bit from it as well as the employee. Obviously, that's something that will just be decided between the employer and the employee and agreed as appropriate. So back to relief at source and how you actually sort of claim the tax relief. So as we talked about, under relief at source, the pension scheme always claims back 20% tax relief. That is the same, even if somebody isn't a taxpayer because they don't earn more than the personal allowance, they may earn less than £12,500. That doesn't matter, they still get the benefit of the 20%. For somebody in Scotland who might only be a starter rate taxpayer, paying 19% tax, they still get the 20%. Everybody gets that. And can keep that under a relief at source scheme. Obviously, it is an issue for low earners under net pay schemes because that's something they miss out on under the net pay system, which is something that the government have promised to look at, but nothing's really happened on that. And obviously, there's a lot of other priorities at the moment. But under relief at source, anybody that pays a higher rate of tax above 20%, to get that extra tax relief, they will have to do something to claim it. There's nothing else that happens for them automatically. So for higher rate taxpayers and additional rate taxpayers, and importantly for Scottish taxpayers, we've got intermediate rate taxpayers as well who pay 21% tax. Those are probably the people that are most likely to forget about claiming the extra tax relief. It might only be a lesser amount. And there may well be people that aren't used to completing self-assessments and haven't had to previously. But to get that extra tax relief, they do need to contact HMRC. So for most people, they will do this via the self-assessment. But it is possible to get the extra tax relief by contacting HMRC directly, contacting the local tax office. If you are a higher rate taxpayer and don't have any other reasons that you need to do a self-assessment, if you're an additional tax rate payer, to get the additional rate relief, you have to do it by self-assessment. That's the only way you can do it. You have 4 years after the end of the tax year that you're claiming for. So, if you sort of discover, you've got clients, maybe it's new clients or whatever, they've not claimed it for a couple of years or go back a couple of years, then, make sure you do it within the 4 years or else they will lose that forever. So yes, they do need to get that in. When it comes to the self-assessment form, this is the section that they'll need to complete. The box that we've got marked out in red there, in there they need to put the amount of the pension contribution, and that will be the net pension contribution plus the basic rate tax relief that goes in there. So, for example, somebody that made a pension contribution physically paid in £32,000 personally into their pension scheme, then you need to enter £40,000 in that box. So it includes the tax relief in there. Very important that they do that. Also, There's a note on here a little bit about annual allowance, and I'll talk a little bit more about annual allowance later. Even if you've exceeded your annual allowance, it's really important that they still complete this with the full amount. They need to claim the tax relief for this section. It may be that they have an annual allowance charge later on, which sort of wipes out some of the benefit, but you need to make sure you get the benefit because you'll have the allowance charge anyway. So really important that they claim the tax relief. So you fill in the self-assessment or you contact HMRC to get the extra rate relief, but how does it actually work in practice? I've got a couple of examples here. We've got Alan, who's got gross income of £80,000. He makes a £32,000 net, £40,000 gross personal contribution. First of all, I'm going to look at the position as if he didn't make the contribution, and then we'll look at comparing that with after a pension contribution has been made. So very straightforward to start off with. Alan's a high rate taxpayer, but he hasn't lost any of his personal allowance, so he gets the full personal allowance of £12,500 tax free. He then has his basic rate band, on which he pays 20% tax, and then the balance of his earnings above the basic rate band, which in this case is £30,000, he pays 40% tax on. So we add that together, his tax bill for the year is £19,500. Compare that now, if he makes that £40,000 pension contribution, what does that look like? Well, he still has his personal allowance, that's fine. And he's still on his normal basic rate band, £37,500. He still pays tax at 20%. But what the contribution does is it actually extends that 20% band. So that is extended, would be up to £40,000 because that's the amount of the gross contribution that is made, but he hasn't got an additional £40,000 of earnings. So it just extends that band so that an extra £30,000 of earnings is now within the 20% band instead of within the 40% band. So it means he pays tax on that at 20% rather than at 40%. So his overall tax bill for the year is £13,500. So basically the contribution extends the 20% tax band. So you can see if he hadn't made the pension contribution, his tax bill would have been £19,500. But after making the contribution, it's only £13,500. So the £6,000 difference, that's the higher rate relief. So effectively, that's what he's claiming back from HMRC. If you prefer to think of it in a different way, you could look at it and go, well, actually, he pays, your basic rate tax goes up to £50,000, and anything above that, you pay 40% tax on, because he's not an additional rate taxpayer. So you know that £30,000 of his earnings, he pays higher rate tax on. He gets 20% tax relief in his pension scheme. It's the additional 20% on that £30,000. So it's 20% off £30,000. That's the extra tax relief that he's getting. Give you another example for somebody who earns a bit more, an additional rate taxpayer, how it affects them. So similar theory here. We've got Barry, but his income is £170,000. Again, he makes a £40,000 gross contribution. So Barry, because his earnings of £170,000 means he's lost all his personal allowance. So his first £37,500 of his earnings are basic rate. He then has 40% tax, but his higher rate band goes up to £150,000. So he has the next £112,500 he pays higher rate tax on, and then the balance of that, his top £20,000, he's an additional rate taxpayer. He pays at 45%. So without making a contribution, his tax bill for the year would be £61,500. If he makes that contribution, he gets his, see, he still doesn't have a personal allowance. He still pays 20% on the first £37,500, but he gets all of that £40,000 contribution. All of that is used to extend his 20% tax band. So he gets £40,000 extension, which he pays at 20%. And then the remaining of his earnings now fall into the higher rate tax band, not the additional rate tax band. So he pays on the balance of £92,500 of his earnings, the balance of his earnings, he pays 40% tax. So his tax bill now is reduced to £52,500. So the difference between those two is the £9,000, and that's the higher in additional rate relief that Barry can claim back from HMRC. And again, if you look at it, you go, well, actually, if he earned £170,000, £20,000 of that would be taxed at 45%, and £20,000 of that would be taxed at 40% had he not made the contribution. So that's why he's getting two different rates of relief, which sort of combine and to give us the answer that we've got there. So moving on to employer contributions then. So employer contributions work quite differently, and from a pension scheme, from a scheme administrator point of view, they're an awful lot easier because the scheme administrator doesn't claim any tax relief on them. The employer makes the contribution gross into the pension scheme, and then it's a question for the company and the company accountant in terms of whether they qualify for tax relief or not. So providing they qualify, employer contributions will reduce the profit of the company and therefore reduce the corporation tax bill for the year. So that's how they get tax relief. A few sort of key points. First of all, employer contributions aren't restricted by earnings. There's no direct correlation in the same way as for member or personal contributions. But they do have to be commensurate. What the local inspector of taxes, when they look at this, is they will look at the remuneration package for the individual. So they have this lovely phrase, HMRC, this wholly and exclusively for the purposes of trade of the business. Basically, the individual, when you look at their remuneration package, so including obviously their salary and the pension contribution and their other benefits, they have to be worth that amount of value to the business to be able to justify it and be able to get tax relief on it. It's an investment business that is expensive management, but it's, you know, it's the same. It's looking at the overall package. Are they worth it? So it's not in itself an issue if the individual is taking dividends of shareholder, senior management, directors, and they're taking a relatively low salary, but they're taking dividends. But if you look at the whole package of their salary and their pension contribution, even the pension contribution could be considerably larger than the salary, as long as that whole package looks right and feels right for somebody of their standing in their company, that they're worth that much to the business, then that should be acceptable. Tax relief can only be paid on the contributions that have actually been paid. That might sound quite obvious, but obviously for a lot of businesses, they will have obligations in terms of this defined benefit schemes. They might have obligations which are shown in the profit and loss accounts of the business. It doesn't matter what they say. It's actually, it has to be, you know, only the contributions that are physically being made that can account for tax relief in that tax year. So, you know, so that's an important point to note. You can't just put it in the accounts that, you know, you owe this, you have this obligation for which, you know, this defined benefit or defined contribution. You can't create an obligation in the accounts one year and then pay the contribution in the next year and get tax relief on it in the year the obligation was created. It is when it's actually physically paid. And again, the deemed date of contributions, goes back to what I was talking about sort of earlier on. Yeah, it's important to get it when the pension scheme has actually received it, which will be important for company year ends as well. Moving on now to refunds then, pensions contributions. Simply the basic rule is once you put money into a pension scheme, it's there. You can't usually get a refund on it. It's normally locked up until retirement under the usual benefit rules. But like most things with HMRC, there are one or two exceptions. First one is for short service. Now with money purchase schemes, personal pensions now, you just have a 30-day cooling off period. So if you make a contribution when you first set up the scheme, you're within the cooling off period, you can get it back. But that's only on a new scheme being established. It's not 30 days whenever a contribution is made. Short service just applies for occupational schemes. So if you've got less than 2 years service, then you may be able to get back the employee contributions. The employee contributions would go back to them. But the other circumstances, which I'm going to look in a bit more detail on, are about this excess contributions condition and genuine errors. So excess contributions then. This is when an individual makes a personal contribution in excess of their relevant UK earnings. So right at the start, we looked at tax relief. One of the conditions was the amount that you can put in is the higher of UK relevant earnings, or the basic amount of £3,600. So if you're found at the end of the year you've put too much money in, then you can have a refund, because you shouldn't have put it in the first place. It was not permitted within the rules. So reasonably common for self-employed, because people don't know what their earnings are going to be. But also, people are planning and sort of loading contributions at the start of the tax year, and then they have an unexpected event. Somebody might get made redundant partly through the year, for example, and it turns out that they haven't had the earnings that they thought they were going to have to support that level of contribution. So in these circumstances, they can be refunded. It can only happen after tax year end, because you don't know how much the excess is going to be until the tax year has ended. So because there's always the potential for them to earn more in the year up until that point, until the year is finished. So we can only do it after tax year end. The tax relief has to go back to HMRC. So if we've discovered somebody's put in too much, then we have to claim tax relief that they weren't entitled to. That has to go back to HMRC. When it comes to the actual the net contribution, the actual amount that the individual has physically paid into the pension scheme, that it is down to the scheme administrator whether they will insist on that being refunded back to the individual, or whether they can leave it in the pension scheme. There's no hard rules on that for HMRC, as long as you get, as long as they get the tax relief part of it back. On discovery of an excess contribution, then there is this 90-day deadline now for HMRC where it has to be corrected, or interest will be charged on it. So obviously there's a lot of times where somebody will think there's going to be an excess contribution before the tax year end, but obviously it can't occur until tax year end, in which case the 90-day deadline would start then on the 6th of April. But obviously it could happen at other times throughout the year. In order to actually process an excess contribution, the scheme administrator will need to see evidence that it is an excess. So normally they would require either a P60, a copy of a completed self-assessment tax return, maybe a week 52 payslip, or a signed letter from an accountant confirming their total UK relevant earnings for the tax year. This 90-day deadline can disappear quite quickly. We sort of have circumstances where somebody might tell us that their client didn't have sufficient UK earnings, and so they meet these conditions, and then we would ask for the evidence, and it can take a little while for us to gather that evidence. But as soon as we're informed, as soon as the scheme administrator is informed of it, that 90-day deadline starts, that clock starts ticking. So ideally, you would have the evidence at the point you tell your scheme administrator. If you didn't know what exactly your scheme administrator was going to need, it might be wise to ask if, sort of the theoretical question, the hypothetical question, I should say, of, saying to, to your scheme administrator, well, if I did have a client that had made an excess contribution, what evidence would you need, without actually telling them who it is? Because at that point, they can't, you can't trigger the 90-day deadline at that point. The 90-day deadline, because I say it can disappear quite quickly, but also because the way that scheme administrators have to report and pay the tax back to HMRC on a monthly basis. So if you just miss the deadline, then you just lost 30 days. Yeah, it's really worth gathering the information first and handing all the information across together wherever possible. If it is the 90-day deadline is missed, the interest charge goes back to the date that the tax relief was actually paid into the pension scheme by HMRC, not back to the date that it was discovered. So it could potentially go back a couple of years. So it could add up, depending on obviously the amount of the excess and the length of time involved. Interest rate has just gone down from the 30th of March 2020 to 2.75%. But previously it was 3.25% that would be charged on that. Okay, the other potential area where you could have a refund is the genuine error rule, and this is probably the one that causes most issues. Let's say with the excess contribution condition, either it is or isn't. It's fairly black and white, really, it's a fact or not. Whereas this one is a bit trickier, mainly because we have a lot of queries that come in because people think people would like a refund from the pension scheme, be it direct clients or advisors, and they said it because an error has been made. But what HMRC define as an error and what a lot of people think are an error aren't necessarily the same thing. So HMRC define an error where we are allowed to refund. It's when it's beyond the control of the person making an inadvertent payment to the pension scheme. So the examples they give is, so a member sends an instruction to a bank to cancel a direct debit, and they've done it in time for the bank's deadlines, but the bank have failed to act on it. Things like browser errors causing duplication, which you can see if a payments come through twice in the same day or in a very short time frame, that we can see that. It might be things like where it's been paid into a wrong account. There's also the other one, which is permitted to do a refund under genuine error, is if an employer has a regular contribution for employees and they've left employment but they fail to cancel it in time because the individual isn't entitled to that payment, then we can do refunds on that basis. But we cannot make refunds for things like exceeding the annual allowance is the most commonly asked one, because somebody's miscalculated it, whether it's an advisor that has miscalculated or whether a client has not given you all the information and therefore your calculation isn't correct because it's not been based on correct information. Somebody's broken protection, that's a really horrible one, but actually that doesn't mean we can do a refund. And even if we did do a refund, somebody did do a refund, it wouldn't stop the fact you'd paid the amount in and you'd still have had broken protection. So it is very limited, and it's really where at the point in time the payment was physically made into the pension scheme, it's only if that wasn't intended. So if somebody meant to make a payment into the pension scheme and then discovered they've exceeded their annual allowance, it doesn't matter from HMRC's point of view, because at the point of time you made the payment, you meant to make that payment. It doesn't matter what's sort of gone on in the background or around it. All contribution refunds now have to be reported to HMRC. So it is very likely that if you did a refund that didn't meet one of these criteria, there's a much higher chance of HMRC looking at it and picking up on it. And if they looked at a refund that had gone through and they didn't think it met the genuine error criteria, then it would be a non-authorised payment and there would be tax charges applied on it. So it is difficult, and it's not a scheme administrators. People are trying to be awkward and not try and help you out, especially when it's an annual allowance one or a miscalculation for whatever reason. But it's just the rules don't allow us, and it is quite strict on that. So it's a bit of an interesting one, but those are HMRC rules. Okay, finally, I'm just going to finish off very briefly talking about the annual allowance. So the annual allowance obviously came in at ADA, used to be an awful lot higher than it is these days, so of course there's a lot more issues now, but it is a maximum amount of pension savings an individual can make each year with the benefit of tax relief. It includes obviously individual making pension contributions to their own pension, plus the tax relief on it, plus any employer contributions going in for that individual or any other third party contributions. Altogether is the total savings. Importantly, it is not a restriction on the amount of tax relief given out when pension savings are made. So all that I've said that's gone before about member contributions, getting tax relief, relief at source, completing self-assessment, getting higher rate relief, getting additional rate relief, it doesn't, the annual allowance and the fact whether you've exceeded the annual allowance or not doesn't impact any of that. You still do all of that in exactly the same way. But if you have exceeded the annual allowance, then the individual may be subject to the annual allowance charge. So it works by applying a tax charge when the annual allowance is exceeded, and the idea of it is to recoup the amount of tax relief given to the part of your pension savings above the annual allowance. So if somebody is making personal contributions exceeds their pension allowance, sorry, their annual allowance, they will still get the tax relief on the full amount as long as it's within the 100% of earnings. But they will have a corresponding annual allowance charge which recoups that extra tax relief. But it's important that they still claim the tax relief in the first place in order for it to then be cancelled out. So it's not a penal tax charge, it just means effectively you don't get the tax relief on that extra bit of the allowance. Obviously, if somebody's exceeded their annual allowance because they've got employer contributions coming in, it doesn't have any impact at all on the ability of the employer to claim tax relief on it in terms of reducing their profit and therefore reducing their corporation tax bill. It has no impact on that whatsoever. But of course, it does mean that the employer might benefit from the tax relief, but the individual pension scheme member may have to pay the annual allowance charge. But of course, they have got more money in their pension, which they didn't fund. So there's still pros and cons on it. I say I'm going to do another session, another webinar where I'll go into annual allowance in a lot more detail, including looking at the annual allowance charge and how the annual allowance charge works, how it's calculated, how you can pay it, looking at scheme pays and things like that as well. So we'll cover that off in a separate session, because otherwise this would be a little bit too long, I think, to do all in one go. Briefly, the annual allowances for this year, the 2021, we have the annual allowance, which most people will have, is £40,000 a year. Anybody that's flexibly accessed their pension benefits will be impacted by the money purchase annual allowance, so £4,000 a year. We then have the tapered annual allowance, which will affect less people now since the budget announcements. So it's only going to affect people that earn at least £200,000, at least £200,000 of income. The tapered annual allowance could be anything between £0 and £39,999. Alternative annual allowance, that only affects people that have triggered the money purchase annual allowance, exceeded it, and have DB schemes. But again, I'll explain that in our later session. And you've got carry forward on top of that. So annual allowances can be quite complex. So therefore, we think that's worthy of a separate webinar in its own right. So to summarise then on contributions, anybody can pay into a UK registered pension scheme, but the member must have relevant UK earnings to get tax relief on them, or they can pay the basic amount, say the 3,600 or 2,880 net, as long as they are a relevant UK individual. Employer contributions are not restricted by earnings. We have the wholly and exclusively rule. Refunds, the most likely scenario you are going to get a refund from a pension scheme will be the excess contribution, that is personal contributions in excess of earnings. There are limited circumstances where you can get them for genuine errors, but they are very limited. And finally, the annual allowance doesn't have an impact on how tax relief is actually given out. Just restrict how much tax relief. You still get tax relief, you just may have a corresponding tax charge on some of it, but there will be more on that one later. So that's all from me. Thank you very much for listening if you've made it to the end, and we'll be back again for some more webinars very soon.